when everybody's panicking about the rest of the market. Given some of the fundamental changes that we're seeing with COVID 19, could we just expect these giants to get even bigger?
Yes, I think you can't expect them to just get bigger, right? Really, all that we're seeing here, the only impact that the coronavirus has had on them is it's a pull forward of kind of the growth trajectory that we already saw happening. People are continuing to transition to the cloud. People are continuing to transition to working from home. And these companies are well positioned to take advantage of that now and going into the future. Right? These are durable and sticky habits.
So what does this mean for traditional businesses? Because what we have seen now is, for example, the big banks, JP Morgan, for example, now being upstaged by MasterCard. Its market share, in fact, market cap has surpassed the U.S.'s biggest bank, as this GTV chart on the Bloomberg can clearly show our viewers. So if we are seeing more of these transactions, shifts in the way that people do business, what does this mean for these traditional businesses like banks, for example?
Yeah. So traditional businesses, a lot of traditional businesses are going to have a hard time, right? Banks in particular, we have a hard time believing in just kind of going forward. We far prefer to be in the payment companies, your transaction companies. Banks are loaded down with large physical footprints. They've got a lot of regulatory burdens. They're faced with a low interest rate environment, and there's not a lot of volatility for them to make money off of trading, right? Whereas the large payment systems, any sort of economic recovery you see, they're in the middle of it. And as people increasingly go digital, they're also in the middle there, and they're in the middle of all those transactions. They're profiting off of it. And beyond that, they can kind of dip their toes into whatever the banks are doing that is profitable. Okay, they want to open up and start having depositors, they can do that. They can get a bank license and start doing that if they think there's going to be money there. So we just really like the upside in the payment companies a lot more than we like the upside in kind of your big traditional names.
Yussef, which I guess pandemic-related, darling stocks that we've seen perform really well have really hit their peak, do you think? I know Zoom is one that you think will probably start to pull back once people start going back physically into workspaces.
Yeah, so we think that there are durable habits, and we also think that there are some habits that aren't going to be as durable, right? So things like Zoom, they're kind of a flash in the pan. They don't have a wide moat. They don't have a huge advantage over anybody else who has the capacity to do video streaming, right? Whether that's going to be Microsoft or Apple or Facebook or Google. And so going forward, we think they have a hard time defending market share, especially if there's any sort of margin there to be made. So we don't think that that's necessarily the best place for you to park your money as compared to some of the other large tech companies that just they've got more cash flow, they've got more prospects for growth, and they have the strength to fend off competition.
So when it comes to the retail recovery, the verdict's still out, right? Because, for example, here in Australia, you've seen surprising upside when it comes to retail sales, to consumer sentiment over the weekend when shopping centres were seen flooded with people on this idea that, the economy is reopening and restrictions are being lifted. In China, you're seeing people lining up, for the latest Nike shoes and this idea of revenge, consumption, if you will. So is there a chance that consumer behaviour may actually surprise us?
I think there's a chance that general consumer behavior could surprise the upside, that this whole downturn has really been a case of consumers not having access and being able to purchase rather than not having the funds to purchase. But I don't think that that's going to be reflected at the shopping malls. I think a lot of traditional retail brands, if you haven't taken the time up to now to build a digital relationship with your consumers, you're in trouble. Reopening the malls you might see a surge in the first week or the second week, but long term, they're going to continue to struggle. And as an aside, if you do have a lot of people back at malls rubbing shoulders and being in close contact with each other, that's probably not great, over the next several months as we consider whether or not there's going to be a second wave of the coronavirus shutting everybody down.
Do you have a preference when it comes to geographies?
In terms of geography, we do think that the United States and emerging markets are probably more set to grow as compared to other developed markets. Developed markets, in Europe and Japan, they're more focused on resource extraction and banking and and we think that the banking scene just isn't necessarily one that we want to be a part of. Lower for longer interest rates, and it's just not as attractive to us as the growth stories in emerging markets in the United States.
And we saw the dollar get a little bit of a boost today, given all of these safe haven moves. What are you factoring in terms of dollar strength?
Well, I think it's like we just said. Dollar strength is a reflection of U.S. markets being the most attractive, right? If we're talking about over the next 5 years, where do you want to park your money? And I told you could buy a treasury bill, or you could buy something like Microsoft. I think a lot of people would say they'd want to buy something like Microsoft. You're pretty sure it's going to be there in 5 years. I told you something like Microsoft versus Deutsche Bank. I think the answer might still be Microsoft, right? So the United States just has higher quality companies, and I think investors are fleeing to the markets that are the most stable and the most primed for growth.
Yussef, just last question in terms of some of these really beaten down sectors. If you're a long-term investor, would you be adding to positions in companies like Disney, maybe some, big oil, given the valuations that we're seeing, knowing that we probably won't see a recovery in the next 1, 2, maybe even 3 years, but that longer term, these are big companies with solid balance sheets that will survive?
I think that it's a great idea. I think a lot of the big companies that have been beaten down that do have solid balance sheets are great investments. Where we're a little bit more cautious, though, is when we look at a lot of the companies that are beaten down that don't have balance sheets that are as great. And that's where I think you have to be really careful, and you're going to see really a wide spread between the returns. Wouldn't be surprising, for example, if one of the airlines ended up going under in the United States. But if you don't pick the one that's going under and you pick the ones that survive, I think there's probably some really great returns to be made over the next 3 to 5 years. So you have to kind of be careful in where you put your money, but I do think there are a lot of opportunities out there in beat down sectors.